The biggest stock market crash in history. Imagine spending years building your savings. You work long hours, put money aside whenever you can, and dream of a better future. Then one morning you wake up to discover that a huge portion of your wealth has vanished. Not because your house burned down, not because someone stole your money, but because the stock market collapsed. Throughout history, financial markets have experienced many crashes, but none have become more famous than the crash of 1929. It was a disaster so severe that it helped trigger the Great Depression, one of the worst economic crises the world has ever seen. Millions of people lost their jobs. Thousands of banks failed. Businesses collapsed. Families who once lived comfortably suddenly found themselves struggling to afford food and shelter. But how did it happen? How did a period of incredible prosperity transform into economic devastation almost overnight? To understand the answer, we must travel back to the 1920s, a decade often remembered as one of the most exciting periods in American history. The Roaring Twenties. The decade began with optimism. The First World War had ended, and the United States emerged stronger than ever. Factories were expanding rapidly. New inventions were changing everyday life. Automobiles became increasingly common. Radios connected millions of households, and businesses were producing goods on a scale never seen before. For many Americans, it felt as though the future had arrived. Economic growth seemed unstoppable. Wages increased, consumer spending surged, and confidence spread throughout the country. People were buying cars, household appliances, and modern conveniences. Cities grew larger, industries expanded, and newspapers regularly reported stories of success and prosperity. At the center of all this excitement was the stock market. For many people, investing appeared to be the easiest way to become wealthy. Every month, stock prices seemed to climb higher. Investors watched their portfolios grow and began believing that the upward trend would continue forever. The stock market became more than a place to invest money. It became a national obsession, the dangerous belief. As stock prices continued rising, something unusual began to happen. Ordinary citizens who had never invested before started pouring money into the market. Teachers invested. Factory workers invested. Farmers invested. Even people with very little savings wanted to participate. Many investors weren't buying stocks because they understood the companies they were investing in. They were buying because everyone else was buying. People saw neighbors making money. They heard stories about friends becoming rich. Newspapers celebrated successful investors. The fear of missing out spread across the country, but perhaps the most dangerous development was the growing popularity of buying on margin. Buying on margin allowed investors to borrow money to purchase stocks. Instead of paying the full price, investors only needed a small portion of the total cost. The rest was borrowed. As long as stock prices continued rising, this strategy seemed brilliant. People made profits using borrowed money. But if prices started falling, those same investors could lose everything. Many didn't fully understand the risk. They only saw the profits, and as more people borrowed money to buy stocks, prices climbed even higher. The bubble continued growing. Warning signs appear. By 1929, some economists and financial experts were becoming concerned. They noticed that stock prices were rising much faster than company profits. In simple terms, the market was becoming disconnected from reality. Many businesses were valuable, but not valuable enough to justify their enormous stock prices. Yet few people wanted to listen. Why would they? Everyone was making money. Critics were dismissed as pessimists. Warnings were ignored. The belief that stock prices could only move upward had become deeply embedded in the public mindset. History has shown that this type of thinking often appears near the peak of a financial bubble. And once enough people believe, prices can never fall, reality eventually proves otherwise. The crash begins. In October 1929, investor confidence began to crack. Large investors started selling shares. Prices became unstable. Rumors spread. Fear slowly replaced optimism. Then came October 24th, 1929, a day remembered as Black Thursday, as panic spread across the market. Investors rushed to sell their stocks. Selling triggered more selling. Prices fell rapidly. Crowds gathered outside financial institutions seeking information. Newspapers struggled to keep up with developments. For a brief moment, major banks stepped in and purchased large amounts of stock in an attempt to calm investors. The intervention temporarily restored confidence, but it was only delaying the inevitable. 5 days later came Black Tuesday, the day that would become synonymous with financial catastrophe. Millions of shares flooded the market. There were far more sellers than buyers. Prices collapsed. Fortunes disappeared within hours. Investors who had borrowed heavily faced devastating losses. Some were ruined financially. Businesses suffered enormous damage. The market had entered free fall, and nobody knew where the bottom would be. The aftermath. The crash itself was shocking, but the true disaster came afterward. Many people assume the Great Depression began immediately after the crash. In reality, the crash acted as a catalyst. It exposed weaknesses that already existed within the economy. Banks had invested heavily in stocks. When stock values collapsed, financial institutions suffered enormous losses. Many banks failed. When banks closed, customers lost access to their savings. Businesses struggled to obtain loans. Companies reduced production. Workers were laid off. Consumer spending declined. This created a vicious cycle. Less spending meant lower business revenues. Lower revenues meant more layoffs. More layoffs meant even less spending. The economy spiraled downward. Year after year, conditions worsened. Unemployment reached staggering levels. Millions searched desperately for work. Many families lost homes, farms, and businesses. People who had once considered themselves financially secure suddenly faced uncertainty and hardship. The American dream seemed to be slipping away. A global disaster. The effects weren't limited to the United States. The world economy was deeply connected. As American demand weakened, international trade suffered. Countries around the globe experienced economic difficulties. Businesses closed. Governments struggled. Financial instability spread across continents. The Great Depression became a worldwide crisis. Its effects influenced politics, economics, and society for years. Some historians even argue that the economic turmoil of the Great Depression contributed to tensions that eventually helped lead to the Second World War. What began as a stock market collapse had transformed into one of the most significant events of the 20th century. Lessons for the future. The crash of 1929 taught painful lessons. It demonstrated the dangers of excessive speculation. It showed how greed can push markets far beyond reasonable valuations. And it revealed how quickly confidence can disappear when fear takes hold. Today, governments and financial institutions have implemented safeguards designed to reduce the likelihood of another disaster on the same scale. Markets are regulated more closely. Banks face stricter requirements. Trading systems include mechanisms intended to slow panic selling, yet crashes still occur. The crash of 1987, the dot-com bubble, the financial crisis of 2008. Each event reminded investors that markets remain vulnerable to human emotions. Technology changes, industries evolve, but fear and greed remain constant. Nearly a century has passed since the crash of 1929, yet its lessons remain relevant today. It serves as a reminder that economic prosperity can create overconfidence, that speculation carries risks, and that financial markets are ultimately driven by human behavior. The people who lived through the Great Depression never forgot what happened. For them, it was more than a market crash. It was a life-changing event that reshaped families, communities, and entire nations. And while the world has changed dramatically since then, the story of 1929 continues to warn future generations about the dangers of believing that prices can rise forever.